Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me for the first time David Kranzler. David spent many years working in various analytical jobs and trading on Wall Street. For 9 of those years, he traded junk bonds at Bankers Trust. He earned an MBA from the University of Chicago with a concentration in accounting and finance. And currently, David manages, or co-manages, I should say, Golden Returns Capital. It's a precious metals and mining stock investment fund based out of Denver. And he writes a blog and offers in-depth, unique research reports to help people understand and analyze what is really going on in our financial system and economy. And of course, that is why I invited David to join me today, because that is the aim of this show, is as stated from the very first show back in March of 2009 when G. Edward Griffin was our first guest, and he's the author of The Creature from Jekyll Islands. We want to help people try to decipher what is really going on out there by filtering out the falsehoods that the mainstream propaganda machine is constantly throwing our way day in and day out. And before I say hello to David Kranzler, let me just strongly suggest that you take down his website address. There you can gain information and David's insights into the markets. That website is investmentresearchdynamics.com, investmentresearchdynamics.com. Welcome, David, and thanks for joining me today.
Thanks for having me, Jay. I've been a long-time admirer of your research work in mining stocks. In fact, when I first got into this sector back in middle of 2001 and started looking at mining stocks, whenever I would do an internet search on it, your name was one of the first ones that popped up. So I was almost... it was one of the few choices that was out there back then. So
back then, that's right. And I'm almost as old as some of the rocks I look at to try to pick mining stuff. So I've been around this business for a long time. There are not too many newsletter writers these days that have been around longer than I. That's in this field anyway. That's for sure. Well, David, thank you for those kind comments, and I'm really glad that we finally got to talk. Just as I noted in your in the introduction that I just gave our listeners, you were definitely a mainstream Wall Street guy at Bankers Trust. Now I think it is fair to call you a gold bug. I mean, you're running a gold fund. You've got gold and gold shares in that fund. And you take a not so reverent view of the status quo. What has caused you to change your worldview?
Well, first of all, I'd like to say in polite circles we call ourselves the gold investing community, not gold bugs.
Okay, fair enough. Yeah, it is a sort of a sort of an adverse term to call someone a gold bug. It makes you look like you're pretty stupid.
You know what? I like being called a gold bug. I mean, trust me, working on a trading desk in Wall Street, I was called much worse, things that you wouldn't want.
I can imagine.
But first off, just to get started, I just want everyone to know that in terms of what's happening with gold and silver now, I mean, the sentiment's it's by far the most negative that I've seen it in the 15 years I've been doing this sector. The mining stocks are just beaten down to the point where, I mean, the Huey index is back to the level where it was when gold was trading around $400 an ounce. I mean, it's absurd. So, and silver was trading between $4 and $5 an ounce back then. So, what I just wanted to say is that we're not wrong about the reasons for owning gold and silver. In fact, if you look at the price appreciation over a 15-year period, gold and silver have outperformed any other asset class that I can think of, including the stock market. If you go from today and take it back 15 years. Where we've probably been wrong on a short-term basis is in underestimating the degree of fraud and criminality that's engulfed our system. And this, I mean, it's widespread, and it's not just corporate America and Wall Street, it's also in the government. And the government's supposed to be the one that polices all this, and yet most of the government officials that are in positions to enforce the laws come from Wall Street. Mm-hmm. So it's kind of like the fox, watching the hen house. So we're not wrong about gold and silver, and one of these days we're going to be proven to be extremely right.
Yeah, I definitely think that's right. And what you were just saying here sort of reminds me of a remark from Marcus Tullius Cicero way back in 58 BC. When he talked about nations that they can survive they're outside enemies, but the people inside, the government itself in this case seems to be in cahoots with the evildoers or with these sort of criminal behavior, and that's what I'd like to talk to you about. I would like to get an idea, David, whether you think that ultimately the laws of economics will trump the bad guys. I mean, that's the notion of free market people. Ultimately, we saw the Soviet Union, crumble under its own statist economic system, I would argue. I mean, some people think it's all because of the mighty United States military that did it, but it was clearly crumbling from within, no doubt about that. And, I think, and you and I would agree that probably that we see a great deal of similarity between what's going on here and what happened in the Soviet Union, as we have thrown away free market ideas here, starting with money, of course. But if I tune into CNBC or Bloomberg television, the general message I hear about the global economy is that the U.S. economy isn't all that good, but we're pretty good compared to everybody else. And besides that, the Federal Reserve is doing a great job. And, sooner or later, we'll be right back. And the United States is certainly ahead of everybody else. We're certainly better than everyone else. Our economy is really good compared to everyone else's, and it's getting better. Can you tell our listeners how you view the U.S. economy and its prospects moving forward?
Well, I guess it kind of depends on what numbers you want to look at. Do you want to look at the rigged, manipulated numbers that are in the script they're reading off of on CNBC and Bloomberg, or do you want to look at the real numbers?
Yeah.
So we've gotten our whole financial market system is kind of assimilated this idea that what if Wall Street says something, then those are the numbers, or if the government reports an economic report, those are the numbers. I mean, the government's telling us the unemployment rate is just over 5%. But I don't know anyone who would acknowledge that number as being anywhere even close to being legitimate.
Yeah.
And the fact that they sit there and talk about it and debate it and dissect it on CNBC and Bloomberg and Fox Business as if those are the numbers, I mean, it's absurd. These are educated people, and whether or not they know the truth, I have to believe they actually know what the truth is. I think they're just fraudulently misrepresenting the situation because they're paid a lot of money to do it. But if you look at, especially really since the fourth quarter of 2014, a common theme that emerges in almost every economic report, and this includes the ones that are manipulated, seasonally adjusted, and they take the monthly number and turn it into an annualized rate, which in and of itself is just a complete injustice to the study of economics and finance. But the common theme has been that a lot of these economic indices and a lot of these economic metrics have now declined back to the levels where they were in 2008 and 2009.
Yeah.
Which is 2009 is when we were, quote unquote, officially in a recession.
Yeah.
So, I mean, you've had really what's occurred is that the Federal Reserve has injected $3.6 trillion in liquidity that's kept the government going because it's bought almost all of the new government debt that's been issued since 2009 and since QE started. And it's injected it into the banking system to keep the banking system solvent. And the banking system has extended leverage to primarily hedge funds and speculators, and it's blown up a stock and bond bubble that is the biggest stock and bond bubble we've seen in the history of this country. Yeah. So, I mean, I think not only is the economy in a recession as it was measured by the Q1 GDP report, I think the final revised number came in at something like minus 0.2% or something.
Yeah.
Whatever it was. If they legitimately measured that, I think it would have been a much higher contraction in the first quarter than what they're reporting. And I think things have gotten worse in the second quarter, and you're especially seeing that in things like retail sales. I mean, the retail sales just seem to be collapsing, especially if you strip out inflation.
Yeah. So the idea, though, Dave, is that they have to keep the animal spirits alive, right? The Keynesian notion of animal spirits. So, I don't know if those people that are reading the script believe, or I think they're getting paid not to think and just simply to look pretty and to do what their bosses tell them. But John Williams, who's been on this show, you would know the work of John Williams, and his inflation numbers are much, much higher than the government's numbers. And so he would be very much in agreement with you that we've never really come out of the recession since from 2008 2009, and that we are continuing on. But nonetheless, they have to keep the animal spirits alive, and one of the things that would get in the way of that and make people cringe, especially Wall Street, is if the gold price rises. And on your blog, you've talked a lot about the manipulation of the gold price, primarily through the paper markets. What do you think is behind the seemingly orchestrated massive smackdowns of the gold price? Do you think it's just simply somebody that's sitting on high that sort of figures that we've got to keep people thinking along the lines of everything is pretty good, and if the gold price starts to take off, it's going to send messages to people to trade their dollars in for gold? Or do you think it's just simply traders acting in their own behalf trying to make a buck?
It's probably, realistically, it's probably 90% the former and maybe 10% traders trying to piggyback the manipulation, making a buck. Uh-huh. So, but as you said it, the price of gold is it's basically your alarm bell for the entire system. Mm-hmm. And if the price of gold goes up, it basically alerts people and alerts the markets that something isn't right beneath the surface, not just in the financial system, but in the economic system. And so they have to keep a lid on the price of gold in order it's basically the same thing as unplugging the warning alarm or unplugging the fire alarm in a school. Sure. Yeah. So that's what's the motivation is behind the manipulation, and the evolution of the paper derivative gold markets has been the perfect setup for them to execute this.
It seems to me that if I were a trader, you're a former trader, so I'd try to put myself in your shoes. If I was agnostic with respect to gold, and you and I both believe that gold is really the money that we should be using because it's an asset-based money, and for a host of reasons, the markets have always, when they were free, chose gold as their means of money, gold or silver. But if I'm a trader and I'm starting to see gold take off and I'm starting to think I can make a lot of money, wouldn't I start getting rid of some other assets and buying gold? So it seems to me that part of the means is of the method of keeping control of the dollar-based monetary system, of the petrodollar-based monetary system, is to keep those traders on Wall Street happy making money trading dollars, petrodollars, in one form or another, rather than getting out of that system and going into gold. Would you agree with that?
Yes, absolutely.
Because I could see a massive move from the traders on Wall Street who really don't care at all about this ideology. They don't understand. I think they don't understand the connection between freedom and honest money. But I don't think they have to. If they saw gold starting to rise like crazy and they could get rich trading it and getting out of paper and into gold, they would do it, I think, in a heartbeat. And I think that's what they have. The policymakers are deathly afraid of.
Well, I couldn't agree with you more. In fact, that's part of the dynamic that we saw. If you remember, gold and silver and the mining stocks bottomed out in late October 2008, mm-hmm. and they started moving higher. In fact, the Huey index, I think, went up something like 200% between October and the end of December that year, and that was in the face of the stock market declining. And so what we saw was a massive movement of capital out of stocks and into the precious metals sector in all forms. Mm-hmm. And I think that's part of the dynamic that they're terrified of having happen again, and they're trying to prevent it.
Well, let's talk, David, just a little bit. David Jensen, who you and I both know, I've talked to him on this show and other people as well. And David and I have done some extensive podcasts in the past about this, the mechanics of how they are controlling and capping the gold price. When I say they, could you help our listeners get a sense of who they might be?
Well, it's because the whole setup is completely opaque by design. So, for instance, when we look at the Commitment of Traders report that comes out every week, and it has, like, you know, the commercial sector, and then the managed money sector, and the retail sector. When you look at the commercial sector, it's basically broken into two subcategories: producers and hedgers, and then the swap dealers, which presumably are the banks. But we have no idea who the banks are. But I mean, I think everyone knows, especially if you just look, the vault operators on the COMEX are J.P. Morgan and HSBC and Scotia. Those are the bank vault operators, and so it's obvious that those are the ones who make up the bulk of the commercial side of the Commitment of Traders report. But I believe, and as I'm sure you do, and everyone in the gold investing community, that these banks are essentially just agents acting on behalf of the central banks, primarily the Fed. And ultimately, I think they're all acting on behalf of the BIS, so the central bank of central banks. And so I think the policy directive in terms of how to handle gold, in terms of how hard to manipulate it, et cetera, I think it gets handed down from on high from the BIS. And so those are your players.
Okay, so let's talk about how they've been able to keep a lid on gold mechanically. Maybe for the sake of some of our listeners who may not be familiar with this process, there's a paper market and then there's a bullion market. Talk to us about the difference of those two markets and how the paper market is really the market that's used to control the price that miners are paid for the sale of their bullion.
Sure. Well, I mean, the physical bullion market historically was in London, the LBMA, and it was supposed to be where physical bullion exchanged hands every day. Obviously it's migrated into also a paper market. But if you want to look at just like the Shanghai Gold Exchange, that's a true physical bullion market where on a daily basis trades get settled up and physical bullion exchanges hands between buyers and sellers. And there's no futures on the Shanghai Gold Exchange. So that's a pure physical bullion market. And the other end of the extreme would be the COMEX, which is 99% a paper futures contract market. There's almost no physical bullion that exchanges hands on the COMEX, even though they do report physical gold holdings in the vaults that are custodian vaults for COMEX gold and silver. So, for instance, the thing of it is a paper market it's essentially a de facto fiat market, because if the bullion banks need to control the price of gold, let's say the price of gold starts to move higher, and the order comes down on high, hey, we gotta squash this. They just print there's buyers on one side that are buying futures, whether or not they would take delivery, but at least they're speculating from the long side. They're following the fundamental side of the story. Hey, this economic report was bad. Let's buy gold futures because they're not going to raise interest rates, for example. Well, the banks who are given orders to cap this, all they need to do to create a cap on the price is just print more future certificates and use those to feed the demand for gold.
All right.
So when it's just like with dollars. The famous Bernanke. We have a technology that allows us to create an infinite amount of electronic dollars at almost no cost. Well, it's the same concept applies to the COMEX. They can create additional paper gold at almost no additional cost, and so it's not a legitimate gold market.
And yet it's viewed as such. The prices we see quoted and in the minds of most people, a $1,100 gold is what is really the true cost of the true price of gold, and yet it has the ratios, as I understand it, are very large. I mean, the amount of paper money, the paper that's printed, paper futures that are printed and spot paper that's printed is so large compared to the actual bullion that's traded is something like 100 times more in gold and even more in silver, I think, something like that.
Yeah, I have I have the current numbers as of this morning, but the COMEX actually isn't really viewed as a legitimate market. The legitimate physical buyers of gold are buying their gold either in London, and I think that's where part of the big shortage that you and I know about that's developing is developing in London for physical gold and silver. Or they buy it in Shanghai. I mean, India. We know India is the second largest importer of gold in the world, but they don't play around on the COMEX. China's the largest importer of gold in the world. They're not on the COMEX. So the real legitimate buyers of physical gold and silver, they're not on the COMEX, but they're beneficiaries of the manipulation that the COMEX creates. So
right.
There's no reason for them to step in there and put a bid in the market and try and find true price discovery for what the true price of physical gold and silver should be. The way I like to think about it, I like to think about it as a trader would think about it. Okay, so if you and I want to buy gold, we can go to the local coin dealer and buy an ounce of gold at pretty close to the price that's as it's set on the COMEX, right?
Right.
And if buyers want to buy, a couple, maybe even a couple hundred tons worth of gold, they can go to the Shanghai Gold Exchange. Maybe not a couple hundred tons, maybe not that large a size.
Dave, I'm going to have to interrupt you because we're just about out of time. We'll have to carry this on in the future, but just let me ask you this, and if you've got 30 seconds to answer it, and if you had endless amounts of buying power out of money that's created out of nothing, what hope is there that we'll ever see a turnaround in the gold price? Is there any reason to own gold? Can't the big guys, the guys that print money out of nothing, can't they go on forever and keep driving gold down and keep us out of the gold market? With 30 seconds, and maybe we'll have to come back and answer that question in the future, but give us your best shot with 30 seconds left.
History tells us that official market interventions always fail. And when they fail spectacularly. I don't think that they can keep up this intervention forever, and I think we're getting close to the end of it.
All right. Well, I wish we had more time, but thank you very much, David, for being with us, and we'll look forward to talking to you again sometime.